Hello friends, now in this study session I will be taking LOS 3 of capital investment and capital allocation learning module, that is describe principles of capital allocation. Means here we will be discussing best practices to be followed when we are doing capital allocation decisions. And common capital allocation pitfalls means the errors or the bias which we may which can be there in the analysis part of the or idea generation part of the capital allocation process. So we know that capital allocation process comprises of 4 steps. Number 1, idea generation. Number 2, your investment analysis using NPV, IRR or return on invested capital method, or third step is your planning and prioritizing, and the last one is monitoring. What are the best practices? First, let's understand those practices which should be followed while doing this capital allocation decision. And of course, we know that after understanding concepts of NPV, IRR and ROIC, we know that NPV method is the most superior method even in comparison to IRR also. So let's understand what best practices or principle we should be following when even doing NPV analysis also. So let's start with the work. So here comes the capital allocation principles. Number 1, the first principle says that after tax cash flow should be used for your analysis purpose. Of course, in case of return on invested capital method, we were using EBIT, net operating profit after taxes. That's why that method is not very efficient method for taking the capital allocation decision. Why? Because when you are doing decision based on when you are taking decision based on this profit number, so there are 2-3 problems in this. First of all, capital allocation decisions are capital projects and they are going to run for more than 1 year period. So just by considering profit of one period may not be the correct way to analyze a long-term project, because long-term project, huge investment is required, there is a heavy risk involved into it, and these projects are irreversible. So maybe initially for first year, maybe a project may be profitable, and for company as a whole, organization as a whole, when you consider the complete tenure of the project, that may not be the correct project for the right project for the company, because initially your profit is very high, you will go for selection of that project, but after 1 or 2 years down the line, you will feel that no, this project is actually not adding value but reducing value to the company, reducing the wealth of the company. So first reason. Number 2, the accounting numbers profit are based on various assumptions. Assumption related to your depreciation, we have to assume your useful life, expected scrap value at the end of life. So in case even while deciding a single number depreciation, we are considering various assumptions, and with the changes in the assumption, the accounting profit can be manipulated. Number 2, the assumptions related to valuation of stock, assumption your policy related to foreign exchange transaction recognition, or the maximum problem comes in case of intangibles, valuation of goodwill and recognition of goodwill. So there are various areas where accounting can be manipulated to increase or decrease profit as per the requirement. So it's better not to use accounting numbers for long-term decisions like capital projects or capital investment. It's better to use actual cash flows, actual after-tax cash flows after considering the applicable tax law of the jurisdiction. What it says, for capital allocation decision, after-tax cash flow should be used rather than profits or accounting-based measures, because accounting-based measures are based on various assumptions, policies, and it's calculated for a very short period, that is 1 year, whereas the project is going to run for more than 1 year. So it's better to go for cash flows, and that too using the complete from start till end, all the cash flows of that particular project should be considered while taking the capital allocation decision. So that is the first best practice. Second, number 2, incremental cash flows only should be used. Now, when we are saying incremental cash flows, it means the decision should not be based on the overall wealth of the company or value of the company. Every project should be analyzed on a standalone basis. And when you are doing this standalone analysis, the impact of cannibalization and other factors should also be considered. In fact, I'll say the concept of relevant costing should be used. What relevant costing says that there are 6 key lines. Number 1, when you are considering a capital allocation or capital investment decision, number 1, anything which you are supposed to incur even before project and even you are incurring after the project, it's irrelevant for analysis part of that particular project. Number 2, if anything you were not supposed to incur before the project, but now you have to incur because of this project, any loss, any expense, any reduction in sales, not reduction in sales, that will come under the receipt part. So anything you were not supposed to incur and now you are incurring, that is again a relevant expenditure, incremental outflow for this analysis of this project. Third thing, anything which you were incurring before the project. Let's assume we were running a factory and now we are thinking to go for utilizing the scrap which we were earlier disposing of. Now we are going to use that scrap to create a byproduct, to create an additional product. So for that disposal, you were earlier incurring a cost, and now that scrap will be used as a raw material for production of another product. So that disposal cost which you were earlier incurring, now it will get saved. So that should be considered as an inflow for this particular project. So 3 rules related to expenditure. Number 1, anything you are supposed to incur and now you are also incurring even after project, before and after you are incurring, so it's irrelevant. Anything you were not supposed to incur but now you are incurring because of the project, cost of plant machinery, cost of additional employees, that should be considered as an outflow for the analysis of project. Number 3, anything you were incurring earlier and now you will not be supposed to incur because of the project, that should be considered as incremental inflow for analysis of the project. Now 3 points from the revenue or the inflow side. Anything which you were supposed to receive before the project and you are receiving after the project, your existing product sales, should not be considered for capital investment decision of a new product. That's okay, because we are doing a standalone analysis, a standalone project analysis. So your existing product sales should not be considered while calculating the NPV of the project. So that's okay. Number 5th, that second point from revenue side, you were not supposed to receive earlier before the project, but now you are receiving that additional revenue which your product will generate from this new project, should be considered as an incremental inflow for the project. And last, most important, cannibalization effect, if there is any, means by launching a new product, new project, your existing product or project sales are reducing. Your new product is reducing sale of your existing product. That should be considered as a loss in the analysis of your new project. You are supposed to receive earlier 6th point or 3rd point of revenue, 6th point of incremental cash flow, relevant costing, or 3rd point from revenue side, you were supposed to receive earlier and now you are not receiving. That should be considered as an incremental loss from this project while doing the analysis. What this principle says that you should be analyzing each project on a standalone basis, including not only the actual cash flows of the project itself, but also the other factors, other effects which this project will make on the other parts of your business. So capital allocation analysis should, and most important, should ignore sunk cost. It include only incremental cash flow associated with the new investment as compared with the without it means you were without project, what was the situation, and with project, what is the new situation. All the differences of the cash flows should be considered in the calculation of your analysis, investment analysis. But most important, one more word, sunk cost. What are the sunk costs? These are the historical costs committed or paid earlier before this project, already committed. Let's assume we have already done a research, and on that research we have already spent 100,000 rupees. So if we have already spent 100,000 rupees and now that particular innovation is now ready for commercial production. Now question comes is whether we should go for installing the facility for commercial production or not. When we are doing this analysis related to installation of the new facility for commercial production, the cost which we have already paid or incurred or committed for that research of 100,000 should not be considered. That is already gone. That has nothing to do with the new investment decision. That should not be considered in the calculation of new NPV of this project. From this point where the idea is already generated, your innovation is already ready, the part of which the expenses which you have already incurred before this has nothing to do with your future decision. Only the future incremental cash flow should be considered, not your past cash flows or past commitments. They have nothing to do with your decision. Next, last part, timing of cash flows. Third principle says that the forecasting of timing, forecasted timing, duration, volatility, and changes in the possible direction of expected cash flow must be considered for a capital investment. When they say volatility, when they say volatility, it means what they are saying. They are saying you should be considering risk aspect also when you are doing the investment analysis of NPV or IRR. It means you should be considering your probability of cash flow. What are the expectation? What is the expected probability, chances of getting that cash flow? And even the risk side, standard deviation, variance of that cash flow or variance of NPV while making the decision of the project, because whether you will be able to take that risk or not, that should also be considered along with the returns. So that volatility part should be also considered while taking the investment decision. That is the last principle of your or best practice for the capital allocation decision. So let's go for best practices. Let's go for the pitfalls, means the errors or the bias which may happen while taking the capital investment decision. So here we will be given certain situation and we may be asked to identify the error or the bias which is happening in the particular analysis. So here we are going to divide these pitfalls into two parts, that is cognitive error, that is calculation and other mistakes, and the second is the bias. Bias means some judgment error, some biasness towards a particular side. So let's go for the first cognitive error. Number one error, internal forecasting error. Internal forecasting error says that when incorrect cost or required rate of return is used for taking the decision of your capital allocation or capital investment. When I say why we are using incorrect rate of return, it means that yes, WACC is very easily available by using the weighted average cost of equity and debt, but WACC is not directly used for every project. Every project has its own risk profile. So if the risk profile of the new project is different from the existing business structure of the company or the of the organization, that WACC should be changed. So if the risk profile of the new project is higher, the WACC should be increased, and then that increased required rate of return should be applied as a hurdle rate or a required rate discounting rate for NPV calculation. And if the risk profile is going down, so you should be accordingly adjusting the WACC. So there, and sometimes even while doing the analysis, few costs are even ignored also, like management time. For new project, management needs to devote time, and that time is going to is in itself going to create a cost for the organization. Technology support, information technology support, or infrastructure support from the existing organization for the new project. Since this cost is already incurring, sometimes people ignore this, but there is an additional workload on the existing facility that is going to increase the cost of existing facility also. So that should also be considered. So we should be taking we should take care about the required rate of return. That should be the correct required rate of return should be used for investment analysis, and the other support cost or the management time cost should be correctly taken. And if they are not considered, it is the first error, that is the internal forecasting error. Second error, ignoring cost of internal financing. Yes, this is a normal or common error which generally is done while taking the capital investments. So when company is making profits, what company can do, either they can distribute it as dividend to existing shareholder, or they can retain it for future investments. Generally, management read that when company is making profit and if it is being retained, so there is no additional cost, because that is the internal funds of the company. Nobody is investing, so nobody is expecting. So either they are not going to use any cost of capital, or they are going to use a very lower cost of capital. No, that is incorrect, because the retention of the profit also belongs to equity shareholder. If company not decided that they should be retaining this profit, they would have paid it to shareholder as dividend, and shareholder must have invested somewhere else, and they must be generating some returns over that value, that amount. So if company is retaining that profit, not distributing it as dividend to shareholder, this money belongs to finally shareholder. Of course, legally company is a separate legal entity, but finally complete wealth of the company belongs to shareholder. So that money, that retention, internal accrual, internal funds what accrued from the company's existing business is also belonging to equity shareholders. So the cost of using those funds should be equals to what the cost equity shareholder, what the required rate equity shareholders are expecting. What it says, internally generated capital is equity financing, and its opportunity cost is equal to risk adjusted required rate of return of external equity. You should not be using lower required rate or some no required rate in case of analysis just by saying that this is the internal funds of the company. No, that belongs to equity shareholder. Inconsistent treatment of or ignoring inflation. Now here is the third mistake which generally done by analysis team. They do complete forecasting based on the price level of present price levels at T0. So many times forecasting team ignore the prices which may increase of raw material, which will create additional burden on the project. And of course, even selling price will also increase of your project, because your capital investment is going to run for more than 1 year. So second year, third year, fourth year, and so on. The cost and the price will get affected by inflation. So while doing the forecasting of cash flows, inflation should be considered by increasing the cost numbers as well as your revenue numbers. Number one. So when we are going to discount, now here we should understand that what we do, we are first of all, your future cash flows in case of NPV, your T1 CF1 should be discounted for 1 year by your required rate of return, and your required rate of return should include two things: real rate of return, that is the actual expectation, along with the inflation premium. This is your nominal rate. So when you are discounting your nominal cash flows, you should be using nominal required rate for discounting. But if you are adjusting your nominal cash flows for inflows for your inflation effect, you should be using the real rate for discounting. Assuming, let's take the numbers. So if your CF1 is equals to 100,000 and the nominal rate is equals to 1 plus real rate. Actually, this is in multiplicative. Real rate and inflation comes in the multiplicative property, not in the additive property. In simple terms, we generally write this additive equation, but not the in real. It is not going to have the additive property. It's not going to follow the additive property. It's real rate multiplied by 1 plus inflation premium. If the nominal rate minus 1 multiplied by 100, because it's going to be a rate. So if your nominal rate is 10% and inflation is let's say 4%, so your real rate is 1.10 upon 1.04 power 1 by 1 minus 1. So this is equals to 1 minus 1, so 5.77%. That should be the rate used when you are discounting your inflows which are inflation adjusted. So if this 1 lakh is at today's prices, this should be discounted by 5.77, and if this is a nominal value, it should be discounted by 10%, the nominal rate. And if it is inflation adjusted value, that you have already considered the inflation effect, means you have reduced the inflation effect, the additional income which we will be getting from inflation, we should be considered. If it is a real cash flow, this should be discounted by 5.77%. So the third, many times generally while doing the analysis, the common error is inflation is ignored. Inflation should be considered. Your cash flows should be including the inflation effect, and your discounting rate should be also including the inflation effect. And if your cash flow is excluding the inflation effect, then your rate of discounting should be also excluding the inflation effect. Next, some bias can happen in the judgment. So this include error in the judgment or blind spot, where people ignore things. Even they know what is right and what is wrong, still we go for ignoring the right things. So first type of bias is inertia. What it means? It means that management anchoring capital budget to prior year amount. Last year we have incurred 100,000 so on a particular project. So this year also we should be investing either 100,000 or we should increase the value, because this project is profit making. Just basing your new investment just based on the new investment is just based on your last year number is incorrect. Along with your last year investment number, we should be also considering the profitability of the project. If year on year profitability is reducing, you cannot be increasing investment amount. Investment amount should go down then in that case, because the amount should go to more profitable projects. So here management anchoring capital budget to prior year amount. So how to identify this error? If the capital investment is static year on year or it is increasing in spite of falling return on investment, invested capital, it means your returns are decreasing YOY, but your investment is either static or it is increasing. It means you are not considering profitability of project. You are just basing your investment amount. You are just what we are doing is that investment amount of the project is just based on your last year numbers. That is the biasness. We should be considering all factors while making the capital investments decisions. Next, second bias. Basing investment decision on accounting measures, that we have already covered in the principal part also, best practices also. When the decision is based on the accounting number, and we know that accounting number are calculated for a very short period of time, number one. Number two, with the manipulation of accounting policies and assumptions, the accounting numbers MPS and EPS can be maximized. So just to, if the investment is or decision is based on EPS or MPS numbers, to increase the EPS or MPS, management may go for more cost cutting or go for more buyback and dividends, which may not be good in long run for the company. So decisions should be based on the long-term cash flow numbers, not on the accounting measures. Then how to identify this particular bias? We should be we should be taking care of the how management remuneration is linked to the projects, whether it is linked to the overall increase in wealth of the company, or whether it is related to a particular short-term accounting number. So if management's remuneration, their incentives are connected to EPS and MPS, of course they will try to maximize EPS and MPS, which may not be very good in the long run for the overall organization. So by checking the composition of management remuneration, their incentives, we can identify this bias, that the investment analysis is done with this bias or not. Next, pet projects, the favorite one. And when something is favorite, a positive bias is always there. So project that receive preferential treatment. Why? Because we have a positive bias. And when we have a positive bias, we overestimate the inflows and we underestimate the cost or expenses, outflows, to create an overall positive picture. So sometimes selected without capital allocation analysis, and analysis done with the overly optimistic or positively biased projection. How to identify it? Evaluate corporate governance structure. Every decision should be analyzed with the your governing body, the board of director, and what is the composition of board of director, whether it is whether the board is having independent directors or not. If independent directors or independent people will be there in the decision making body, then of course this biasness will be less. It is generally recommended that more independent people should be there in the final decision making body, so governing body. So pet projects, to identify this bias, we should be checking the corporate governance structure of the company. And what are the warning signs? If there are less independent people in the governing body, then or directors in the governing body, then of course this bias will happen. More executives will have their own preferential treatment for their preferred projects. Next, last bias. Last bias is failure to consider investment alternative or investment sources. This is the error in the first step of the capital allocation process, that is idea generation. Idea may come from any source, your lower management, executives, even maximum idea come from the actually lower management. Reason being, they are connected to the end consumers. So they know what end consumers are actually, end consumer actually need. If top management is not taking feedback from lower management, many idea will not come into the picture. So all type of ideas should be considered, even if it is the source of idea is not the should be base for decision making. It's the actually the I'll say the potential of idea which should be considered, not the source. Even if it is coming from an external agency, external expert also. So we should consider all type of ideas before going for an investment decision, because once you are committing amount of investment in a particular project, these are generally irreversible. and the funds are generally limited. So if we have committed funds for one project, we will not be having funds later for other projects. All ideas should be considered thoroughly. The first step of capital allocation process is idea generation. It fails uh, if all possible viable alternatives are not considered. Further, capital analysis should incorporate break-even analysis, simulation, and the scenario analysis. So it should not be a fixed numbers, fixed analysis. It should be more dynamic by considering break-even analysis, various scenarios, positive as well as negative scenarios, and we should be simulating what will be the impact on selling price or volume or cost structure while doing the complete analysis. So what are the three best principles? The three best principles are: number one, we should consider after-tax cash flows, not the accounting numbers, profit numbers, GP, NP or EBITDA. We should be considering incremental cash flows, not the sunk cost, but all the incremental cash flow, including the cannibalization effect if there is any. Third, timing of cash flow should be considered along with its volatility, that is probability and risk. What are the pitfalls? First type of pitfall is cognitive error, mathematical error or mistake. That include number one, internal forecasting error, where you are using incorrect cost required rate of return, or you are ignoring or you are understating the cost of management time and use of existing facility of the business. Number two, ignoring the cost of internal financing. Either the internal funds are also belonging to equity funds. Their cost should be equals to the internal funds should have equal cost required rate of return, which the equity investors are asking for their external finance, which they are doing in the business in the form of capital. Third, inconsistent treatment of ignoring inflation. Nominal cash flow should be discounted by nominal rate, and real cash flow should be discounted by real rate of return. There are few bias which can create, which may create error in decision making. Number one, inertia, means you are considering your investment based on the past investments, not considering the overall picture, including the profitability in the analysis. So that is one first bias. Number two, it's actually we were doing this, so we should be continuing this. We are not thinking all factors while making the decision. Number two, basing investment decision on accounting numbers. Again, we have already discussed it's even not the best practice also, and this is going to create a conflict of interest also. Management will try to push EPS and MPS so that investment proposals are accepted. Their preferential investment proposals are accepted, which may not be good in the long run for the company. Second last, pet projects. Pet projects, here this create a positive bias, overly estimating the revenues, inflows, and underestimating the expenses. We should be checking the corporate governance structure here, and failure to consider all alternatives or alternative sources while doing the first step, that is your idea generation. And we should be considering break-even, scenario analysis, and simulation when we are doing the NPV analysis of the project. So with this, we are done with the first, your best practices or capital allocation principles and capital allocation pitfalls. Question can be of true, false, or given a situation, you will be required to identify a error or a principle which is not being followed. So I hope everyone understood it. Thank you so much.